Hello students, good day to you all and welcome back to the Financial Academy. In this session we're going to focus on commodities, specifically the gold and the oil. We're going to go over the current price, the effects that we need to consider once we decide to analyze and trade the gold, and obviously a bit about the past to see what change occurred, and well, basically everything comes down to liquidity. So let's move forward to our charts. So first of all, today it is the 7th of April 2018 and the current gold price is $1,333 for an ounce. Let's zoom out to see a wider spectrum of change that occurred on the gold price. So first of all, we will begin with a monthly chart. As you can see, moving backward to 2000, you see that back in 2000, the price of the gold was approximately $300. Fluctuating between 350 to 300 to 250, and you can see this significant uptrend that occurred for approximately 10 years, climbing up from $300 toward the $1,900, peaking at 2011. So generally looking at this chart, we can say that we're in a corrective pattern at the moment. We're practically correcting the large uptrend that occurred during these 10 years. Just before that, another large corrective pattern occurred back in 2008. But you can see that definitely after the subprime crisis in the United States, there was a large uptrend on the gold prices. Now it's very logical considering the gold being the safe haven of traders. Well, that was the case back then. So from 2011, we can see that the market dropped down significantly from $1,900 toward the almost $1,000 for an ounce. And from this position, it climbed back up and fluctuated around the $1,400, between the $1,400 to the $1,200. Now the thing that I'd like to highlight is the difference between what happened back then and what we can see right now. Although the US market is not experiencing the same formation as we had back then, but still we can say that there's a large weakness, or let's say large fear impact on the current market status, and I'm talking about the US stock market. In terms of the fundamental aspect, when we hear threats on behalf of Trump taxing importing merchandise from China, and understanding that the effect on the US stock market is seeing additional weakness, in addition to what we saw for the past month, we were expecting the gold to form a larger uptrend movement than what we can see over here. Remember, it all comes down to measurements. So if you'll put the effect on the same scale, we were expecting it to climb significantly higher, at least toward the 1500. But the thing is that back then, 2008, the gold was really the safe haven of traders, meaning that whenever some weakness was approaching the markets or some fear was implanted in the markets, we saw traders pulling their investment and moving forward to the gold, expecting it to continue its uptrend movement. Now I'd like you to see this image. Putting the chart back to this condition, you can see that we're talking about a large uptrend movement, meaning that the confidence in the gold was enormous. So it's not considered to be the safe haven of traders all of a sudden. But back then, looking at this image, it's indeed showing a good potential to invest when all the other markets are expressing weakness. And in addition to that, the logic behind seeing a weaker dollar impacted by the weaker US stock market was very logical. And we know that when the dollar is losing strength, being valued with dollars, the gold is expected to climb up. So indeed, after that, we saw a major uptrend movement. But after that, right now, we can see that there is no large impact. And in another analysis, we've talked about the euro in front of the US dollar, as the dollar is losing strength in front of the euro significantly. Approximately 8% for the past several months was lost on behalf of the dollar in front of the euro. So we can generally say that the dollar is losing strength in the market, but no expression on the gold. And this is what I'm talking about when I'm saying that the crypto market is slowly becoming a safer investment. Although right now we see that the Bitcoin dropped down toward the $6,000, fluctuating between the $7,000 to $6,000 for one Bitcoin. But still, it's a very important impact on the value of the gold. And we had another example for that. Back then in 2008, when the subprime crisis occurred, we saw a lot of traders moving their investments from the US market toward the Swiss franc. Therefore, the Swiss franc gained a lot of strength in a very, very short period, but still there was a major fight between the Swiss franc and the gold, competing on the position of becoming the safe haven. Now, there is a large question mark regarding the gold because, again, we can see that it's not climbing as we were expecting it to, considering the current status of the US market and the value of the dollar. And we could say that for the past 2 years, it's just fluctuating around the same territories. So considering this idea, I would say that the only logical thing regarding the gold is to look for a downtrend potential. Because as you can see, a major quicker downtrend was expressed over here, while it takes a lot of time for it to climb back up again. And we can see the same effect in this period as well, but again, it's too far from the current status. And we know that in terms of the fundamental aspect, the condition that adds or takes strength from the gold has changed. So the only thing that I can say about the gold is that the potential right now is to catch a large downtrend movement, and that will be a good position once we will cross a specific trend line that defines this specific uptrend. The assessment is to see approximately a drop down toward the 1100, meaning approximately 17%. Now I remind you, we're looking at a monthly chart, meaning that we're talking about approximately a year from now of a downtrend movement potential of the gold. Another thing that I'd like to cover will be the oil prices, seeing the potential over there. So again, looking at the large impact that occurred on the oil prices, we can again see that during 2008, at the beginning of 2008, we received a large uptrend movement, but after that, a major collapse, a downtrend movement on the price of the oil. I remind you, once we're dealing with a crisis, it means that it will take some time until the economy will express a less need of oil when it comes down to the industry side. Now, the oil is a commodity. It's being valued with dollars, and while the dollar lost strength, the oil was losing strength as well, meaning that we've got a larger impact on the oil prices because we were expecting the oil to climb up as the dollar was losing strength. That was the initial impact over here. But after that, the oil just collapsed, dropping down from $145 for 1 barrel toward the $35 for a barrel. Then we received a pullback once the economy expressed better conditions. But then again, we've reached this territory over here when we had a large production on behalf of OPEC that caused the prices to drop down significantly. Additional reasons was causing this downtrend movement, but generally we're talking about a plain simple supply and demand. Additional supply while the demand stayed the same, and therefore we've received this major downtrend movement. At this position, we started to see some OPEC meetings that came out with limiting the production and therefore lower amount of oil, while the need for oil stayed the same, then caused this uptrend movement. Over here at this position, sanctions were lowered from Iran, and therefore we've received additional production to the global market. And at the moment you can see that it returned to the uptrend movement, but again fluctuating around the $65 for 1 barrel for the last 4 months. Now regarding the potential of the oil, we see it continue its downtrend movement. We're expecting the oil to drop down additionally toward the $50 for 1 barrel at least. In this position, we will be able to reanalyze the structure that we will receive, and then we can make some adjustments for our target. And that completes our session regarding the gold and the oil. Now, I'd like to say that it's very important for us to connect the use of the fundamental and technical aspect. Trading is not only about experience, and it's not only about logic. It's the connection between them. And in order for you to trade successfully, you need to be in the market for quite some time. Just at this position, you'll be able to make an assessment based on your logic and experience. The last thing that I'd like to mention is that these days are pretty different from what we're used to. As in the United States, there is a president that doesn't understand the concept of being a politician on the good side. In the past, we were listening to news on behalf of the US government, and we were trying to understand what's going on behind the announcements themselves. But today in the United States, we've got a president that talks plain simple about the reasons and the results that he'd like to achieve. Now, it doesn't mean that that's better in terms of our technical analysis or fundamental analysis, but it's just a bit of a different way to attend the markets. And with this note, I'd like to wish you all the best. Have a pleasant week, and bye-bye.